So the share owners, of course, expect growth in profitability. They expect dividends to be growing, etc. We have P and the G's integrated the growth strategy. Of course, for those guys who did AFR last semester, you must be remembering something, however small, from a distance, something that we call the OTR integrated reports. Now, this is where I would want us to really throw our eyes, where you can see in summary form, they have given us an income statement until this very last end thing there, where they're able to give us dividends per common share over a number of years. So you can see in this case here, they began with 2.7 in 2017, grew to 2.79, 2.90, 3.03, and we are talking of 3.24. So meaning automatically that this is a blue chip company. This is a blue chip company. Blue chip companies are those companies whose EPS, whose dividend per share does not reduce regardless of the economic situation. Imagine this is the COVID-19 duration, and these guys here were posting a higher dividends every other year. Okay, so they have given us 2021 net sales by business segment. The accountants here have to be very great. People can see how they're trying to portray their data. Accountants in Kenya here can't do this, but I suppose you guys, after attending these particular sessions, most probably in future, you will be able to do what here, you will be able to really produce this kind of statements. So you can see we have 2021 net sales by geographic region. Remember nowadays, because of what we call the basic erosion of profitability, right? Brought about by what here? The concepts of transfer pricing, companies that are multinationals, which are operating in different countries, are required now to show like how much income do they make in North America. You must show how much do you make in India, Middle East, and Africa. IMEA, 6%. So you must show this because of the transfer pricing. You know, multinationals are really using this concept of shifting profits here between nations to be able to defraud very many governments. So what they do, they shift most of their profits to tax havens, where taxes are almost zero. And once that money is there, so they'll be able to pay themselves dividends from this kind of what we are calling tax havens. So is there any student here who knows of a very good example of a tax haven? Is there any student who knows of a very good example of a tax haven? I don't know what is a lie, a says. Panama, yes. Panama, yes. Cayman Island, any other? There are very many. If you want to know that you are successful as an individual, if you are successful, you must be having an account in one of these tax havens. If you don't have an account or a company registered in one of these tax havens, automatically you are a hustler. You are a hustler. You are a hustler. Great, great. US can't be a tax haven. Remember, tax havens, ladies and gentlemen, they have a lot of clauses on what here, secrecy. I know, like even Dubai itself, of course, Dubai will give you better rates, tax rates. But you see, it is not a tax haven, because if you go and register a company in Dubai, Dubai will easily expose you. They can't, for example, tolerate anything to do with money laundering. There is quite a lot of things you have to do when you really reach Dubai. For example, declaring how much cash are you walking around with. In tax havens, those guys, they will let you get into those countries even with billions. With billions, they don't care really. They don't care. Like in America, you can't do that. In America, you can't do that. Now, ladies and gentlemen, please listen to me just in 2 minutes before I show you what we shall do. So here you can see great things, great things. Dear share owners, they're able to give you the organic sales, the core EPS, adjusted free cash flow, productivity, etc. This is not what I want to teach you today. Today, what I would want to teach you guys is this. winning strategy, a strong and focused portfolio, P&G 10 category portfolio. I would really want to see you guys, like Assis, you were saying that you are able to do better financial statements, better annual reports. Remember, annual reports nowadays, they are integrated, right? You must have a lot of explanations. I would want to see your company's financial statements. I would want to see your company's annual reports. Great. So why was I showing you all this? It's because I've got a very good. I have got very good things for you today here. Let me go to Excel. So in this Excel, whatever financial statements were given in that report, I have been able to extract and put them in Excel. It's a PDF. Changing a PDF to Excel is very easy. It's very easy, right? So if, for example, you are given, this is Procter & Gamble balance sheet, 3 years, starting with 19, 20, and 21, 3 years, balance sheet, flowing all the way up to total assets. And then we have total liabilities and equity on this side. Don't worry about why they are putting these things separate. Remember, this is an American company. It's an American company. They don't follow really IFRS 100%, but at least they can guide us. Now, so why would I want you guys really to see this? I would want us, ladies and gentlemen, here to compute ratios and see whether this company, is it really healthy? And I would want us to start by computing the current ratio here, the current ratio. So I would want to see whether there is any student you can't see. What about the other students? Are you able to see the Excel sheet? Can't see the screen. Okay, thanks a lot. Thanks a lot, Sherilyn. Let me repeat this again. What may have happened? How about now? How about now? How about now? Now they are saying they are able to see. Yes, thank you very much. And Peter Moore has even gone ahead to give me the formula. Peter Moore has gone ahead to give me the formula. He has told me that current ratio is current assets over current liabilities. You must make your own notes today. You must make your own notes today. Write somewhere there that current ratio equals current assets divided by current liabilities, divided by current liabilities. It's basically a measure of liquidity. So then what I'll do, I'll just come beside here and say equals to get started. And then I'll be able to pick the current assets in 2021, they are there. And then I'll be able to say here, divide by. We have current liabilities here of 2021, like that. And then I'll be able to say enter. So I'm able to see that the current ratio of Procter & Gamble, such a big company, in the year 2021 is 0.7. Is that very healthy? Debatable. Although we know that great companies should never have their current ratio being less than 1. It's always healthy to have your current ratio being somewhere in between 1 and 2. It should never exceed 2. It should never be below 1. Should never be below 1. But again, remember, the more the amount of cash you hold as an organization, also there is what we call the opportunity cost. So if it's a very efficient organization that really has proper plans, then the company can have below 1. If the company has got very strong internal controls, they can take that risk of having below 1, of having below a current ratio, which is below 1. Like Safaricom's current ratio has never been more than 1. It's always less than 1. But you can never hear them, in this case, you're doing what here? Suffering from liquidity. So whenever they realize that they're accumulating a lot of cash in banks, what they do, they'll go and buy, for instance, they'll go and buy government bonds. They don't want liquidity with them, right? Right. So 0.7, that's okay. Now, what about this DSO? DSO, we are talking of days sales outstanding. Days sales outstanding. Can somebody give me the formula? Just try giving me the formula of days sales outstanding. It is the same as receivable days. Receivable days. Can somebody try there? Please write for us the formula. Days sales outstanding. Days sales outstanding, which is the same as receivable days. I'm giving you 1 minute. I can see charts coming in thick and fast. Yes, that you should take receivables over sales times 365 days. So could you kindly copy that formula? Days sales outstanding or receivable days. Thank you very much, Jabir. Thank you very much, Asezi. So all of us, have we been able to write that formula somewhere, or later on you'll start calling me late at night asking me, Mwalimu, repeat that formula again. It's not wrong to call me at night. Of course, I'm Mzee. You can call me anytime, but at least I would rather for today write these formulas. Days sales outstanding or receivable days. You take the receivables divided by sales. Of course, we assume that all the sales of the company are credit sales, right? So assuming these guys have been able to write their formula like that, so I'll be able to come here to the second there. So I say equals. So here I'm looking for receivables. I'm looking for receivables. And remember, it's not just any other receivables, but accounts receivable. Accounts receivable, right? Our debtors. So like in 2021, they were 47.25. Then I'll be able to say over, I will be able to look for the income statement, profit and loss is where I'll be able to pick the sales for 2021. Net sales for 2021 is there, all right? And then straight away, I'll be able to say enter. So when I say enter there, I can see it is telling me 0. Actually, I'm wrong. Why? Because when I say here equals, and then I took receivables divided by, in this case here, the sales, I forgot one thing. So because I forgot something, I'll come and say here F2 to return back the formula. I forgot what Asezi and this other gentleman had told me of 365 days, right? And then I'll be able to say enter. So I have there how many days? 23 days. So go ahead to the next one. The next one is days inventory outstanding. Days inventory outstanding. What we call inventory days. What we call inventory days. Inventory days. What we call inventory days. Thank you very much. Again, the two gentlemen are telling us it's inventory over cost of sales as a Z, because inventory is under cost of sales. Inventory is under cost of sales. Inventory is under cost of sales. So in this case here, days inventory outstanding, I'll take here the inventory of 2021. I'll come and say divide by cost of sales. I'll get this in the P&L. So I have cost of sales is there. I can see it's negative. I'll be able to change later on. So after that, I'll be able to come and say times 365. 365, and then I'll be able to say enter. So I'm getting negative 59. Of course, you and I know the fact that there is no possibility of these days ever being negative. So what I need to do is to come and say F2 to bring the formula, and then in front of D there, immediately after equals, I introduce a negative, right? And then I'll be able to say enter there to make days can never be negative. Days can't be negative. Days can't be negative. So we talk of days inventory outstanding. Remember, these are the inventoriable days. Inventoriable days, what do? You take the inventory of the company, you divide by cost of sales times 365. From there, we go to the days. Now under our payables, the days payable outstanding. The days payable outstanding. Is there somebody who can try writing for us the formula of days payable outstanding? Days payable out, which is the same as payable days. The same as payable days. The same as payable days. Payable days. Payable. Payable days. I'm waiting to see the charts. I can see there are 3 here which have really come in thick and fast. Yes, it has to be again over cost of sales because payable is a natural sister or brother of purchases, which is normally under cost of sales. Yes. Thank you very much, Kayleen. Great. So then what I'll do here for days payable outstanding, I'll come and say equals here, pick the accounts payable of 2021. Then I'll be able to say over. I go to cost of sales in the income statement P&L there. So the cost of sales here is like that times 365. And because I saw that negative somewhere, I know at the end of the day, I'll just keep here and say negative there to basically get a positive DPO, Thank you so much. I hope you're making some progress there. Is there anybody who is able to give me the formula of net trading cycle? So when I give you these financial statements of Procter & Gamble, you'll also be able to see what they did, or rather that through their calculations, they were able to get similar answers to ours, which is very good for me because I'm able to compute now parameters for an American company, meaning that we are now sharpening our skills as accountants. Anybody who is able to remember the net trading cycle? It's very easy. Net trading cycle, what we normally do, you take the receivable days. Receivable is an asset for you, right? You say plus, so you say plus the inventory. Inventory is an asset for you. And then you say minus payable because payable is a liability. And then you say enter like that. We have minus 53. The net trading cycle can either be positive or negative. Can either be positive or negative. At least I'm able to remember something, days receivable plus. No. You know, payable and receivables can never be on the same direction. Those two must be in the opposite direction. So assuming I never had inventory, then I would have taken receivable minus payable days. Thank you so much. How about debt ratio? Is there somebody who can remind us the formula of getting debt ratio? How do we get debt ratio? How do we get debt ratio? How do we get debt ratio? Debt ratio is quite an interesting one. To get debt ratio, ladies and gentlemen, we normally take debt. We normally take here debt. Debt. You say divide by, open brackets, open brackets, open brackets. Debt plus equity. Very important. This is the debt ratio. But again, remember that debt and equity is always equal to assets. Is always equal to assets. So in this case, you'll always get people saying that debt ratio is debt all over total assets. Debt all over total assets. Right? And the easiest way of getting this total debt, what you do, you simply give us the total liabilities, right? Total liabilities, right? Remember in those old days, we used to talk of long-term debt, like these ones here, long-term debt. But nowadays we talk of what here? Even current liabilities add up to the gearing of the company. They add up to the gearing of the company. So whenever you want to get debt ratio, then what you do, you simply go here and give us the total debt being the total liabilities of the company. And then you say, divide this by the total assets of 2021. They are there, right? And then I should be able to say enter. Then once I finish this, what I'll need to do is simply to highlight this using the white plus, and then I come at the end here, there are 3 years, I drag like that. Then I'll be able to get ratios for the other years very easily. And then now I can go to the commentary section. Great. Great. So can I share this Excel sheet with you so that you guys can calculate them on your own? Are we ready now to do the exercises? Are we ready to do the exercises? Are we ready? Can I give you this? You try it on your own. You try this on your own. You try this on your own. Because if you don't try, I repeat trading cycle formula, trading cycle formula, trading cycle formula, trading cycle formula, trading cycle formula. What you do, you take the receivable days plus inventory days minus payable days, minus payable days, minus payable days. And then Amos wanted me to repeat the last part of debt ratio. So the debt ratio, what do we do? The formula is here. It's debt all over debt plus equity. But you see, debt and equity basically defines total assets of the firm. So you'll take debt, total debt is total liability. So like now here, what I did, I came and said equals there. And then I picked for 2021, I picked the total liability. And then I divided these by the total assets like that. And I was able to say enter, right? So I don't know whether the last part, maybe Amos wanted me to repeat this, where basically you come and highlight like that, and then you'll be able to drag this like that. You're able to get that, those answers very fast. Great, great, great. Now they want great, great, great. Why don't I want to give you this Excel sheet as I do it? Because I would want this to trouble you a little bit. I would want you to do some research a little bit on this. So what I would want us to do, ladies and gentlemen, I would want us to come here. I've also been able to put some other ratios here, which I would want us to calculate. Yeah. Another set of ratios, another set of ratios. So for instance, we have the interest coverage ratio. Is there somebody who knows the formula of interest coverage? Interest coverage. How many times will our EBIT cover the interest expense? How many times? How many times? How many times will our EBIT, operating expenditure, operating expenditure, operating expenditure? Can somebody help? Can somebody help Galaxy Man? Galaxy Man, those formulas. Galaxy Man will get the video. Nowadays, you send the video very early. You'll get the video. Don't worry. You just pick it from here like a buffalo soldier. You fight on arrival. You fight on arrival. Of course, you guys can't be knowing those good old songs. When I go to my gym, I normally hear some music that is played there, which belongs to a generation. Dangerous music, dangerous music. So in this case here, as Asia has told us, interest coverage, we are looking at the curve. So we are looking at EBIT over interest expense. EBIT over interest expense. So here I have this EBIT. I divide by the interest there. Of course, it will be negative because this is negative, right? So that I would need to just change this, put a negative in front there to make it positive. Then I say enter. Like this is a very strong organization, an organization where EBIT can cover interest 39 times. If you want to know how exposed you are as an organization today, I'm so sure that you guys have income statement of your companies. You're the accountants. You are the accountants. That one, I'm so sure of that. I know you have your company's income statement. And I would want you guys to do me a favor. I would want you to go and pick the EBIT, what we call the operating profit, and then you divide by the interest. You realize most of African organizations like Kenya Airways, if you try today, because their financial statements are also online, if you take the operating profit, you divide this by EBIT, you will get 0 point something. Why? Because in most cases, operating profit is less than the interest. If you take, for example, if Kenya was to produce financial statements, our profit from our operations I'm 100% sure will be less than the interest that we are paying as a nation. So if you get an organization whose interest coverage is even 5 times, you should stand up there and call for the CFO and the CEO of that company and salute them. Those are mighty, they are superstars. They are superstars. They are good in terms of corporate governance, in terms of running that entity. Otherwise, most of your entities in this case here have a very bad interest coverage rate. You are exposed. You're exposed. When you have 0 point something interest coverage ratio, you are too much exposed. And when it becomes negative because your operating profit is negative, if your operating profit is negative, such that now your interest coverage ratio is negative, then automatically you are bankrupt. You should not even be operating at all. You should be taken to court. You can't pay any liabilities. You're useless. Great. Now, if you allow me, then I'll be able to come here and work this out with you. This thing of ROA, can somebody in this case here remind us, how do we get ROA? How do we get ROA? This thing of ROA, how do we get ROA? Net income over total assets times 100%. Net income over total assets times 100%. Let me ask you a question. Had you done this topic? Had you done this topic with my colleagues? You seem to be knowing it. Oh, some video. Okay, so could you be knowing the video number? Could you be knowing the video number? Could you be knowing the video number in that series so that the new students can also watch that video? So that the new students can also watch that video. What's wrong with this Excel of mine? I can't now go to, yes, great. So when we talk of ROA, return on assets, we are looking at the net earnings or net income. Net income. How much in terms of income are these assets able to generate? How much in terms of net income are these assets able to generate? Today, if there is anybody I'm missing totally out of our today's discussion, is Jacqueline. Is Jacqueline well and alive? Is she okay? Is she able to follow these things? Or she is somewhere worried about GMO and maize farming in Kericho? Anyway, Jacqueline, are you around? It's not her alone. I can see I'm walking this journey with some 2 or 3 students, which is quite sad, and yet this is very practical. This is very practical. You know, there is nothing as bad as finishing your CPA. Finished even your CPA. Not all well. So you finished your CPA, and then you get somebody outside there asking you, hey, can I invest in shares of Kenya Airways? You can't even give a simple advice. You can't even tell these people, you know what, let's pull these financial statements of Kenya Airways, or it's heavily raining in Kericho. Let's pick these financial statements of Kenya Airways, and then we interpret them together, and then you drive the way. So this is something that is very, very practical. So if there is anything that we will need really to put all our 2 feet into it, it is this one. You must understand this. Very important. So what have we said about return on assets? Which return are we talking about? These assets are producing the profit after tax. They are producing the net income. So I should take the net income divided by total assets. Net income divided by total assets. Net income divided by total. So I come here and say equals, I can see net earnings there, and then I'll be able to say divide this by the total assets. Total assets, I can see them here like that. And then I'll be able to say enter. So there I am in form of percentage, if you wish, 12%. So when you come to return on equity, again, the same. I will come and pick the net earnings, but this time around, I'll say here, divide this by the shareholders' equity 2021. like that. Say enter, getting 31%. Then we have EBIT as a percentage. Of course, it's EBIT as a percentage of sales. EBIT as a percentage of sales. So equals, I'll come and pick EBIT here. I say divide this by the sales figure, like that. I say enter. When they talk of net income percent, it is this net earnings. So I'll come and say equals there. I pick the net earnings. I say divide this by the net sales, like that. Then we say, in this case here, enter. And then now I've finished all these. So then I would want to come and highlight them. And then I throw these to the other years, like that. Great. Done. Like I can see the year 2019 was quite a bad year. If you see 2019, it was quite a bad year. It was quite a bad year. If you see this 2019 was quite a bad year. 2019 was quite a bad year. Was quite a bad year. If you look at 2019, even from the net income itself, this was quite a bad year. You can see we began, this one we're moving that way. It's from 2019 to 2021. You can see we began lowly here and then we went. And this 2019 was this poor because you can see the impaired goodwill materially. Look at the figure of goodwill impaired, 83.45. In relation to the net assets, I mean, this figure is so much, so big. It doesn't appear in the other years. So when somebody comes and tells me, like, these CEOs will always try to play around with directors. They'll come and tell you, what, that we have done very year. Look at how very well this year. Why? Look at how the profit margin has grown in the year 2020. I'll tell them, hey, don't joke around with this old director. I know 2019 had an exceptional thing. It had goodwill impaired. Let's remove this goodwill impaired. That's what you tell them. Let's remove this goodwill impaired. You tell them, you're now removing the goodwill that was impaired, and then we start looking at your figures. So when I come here, assuming I remove this, yeah, you can now see this. There is nothing this guy is telling me really. This was an exceptional thing, right? So there is no way, people will really be cheated, right? And now you need to look at when this guy, when the deal is too good, always think twice. When the deal is too good, always think twice, Control Z, I go back like that. So you can see all over. This particular 2019 year was really affected because of the goodwill that was done what year that was impaired. So that is it. So let me send you this. Should I wrap this, or I send you with this and then you will be able to see the formula? No. That is making you guys lazy. I should be able to wrap my figures here before I save this, so that I send you something that is clean. Great. Procter and Gamble. Let's do the commentary first. Yeah, also revaluation of biological assets, any revaluations, whatever we get there, ladies and gentlemen, should not really, somebody should not be able to talk very positively of any revaluation surpluses obtained in terms of boosting their what year, their profitability. Great. Great. Financials, I come here. PG, okay, great. Oh, this is quite a big coincidence. Okay, great. Great, quite a big coincidence. Margaret, they are distributing goods to Procter and Gamble. PG. Open. Ben, don't get personal, Ben. You, Ben. Ben wants to know the distributor's name. No. Those are now things if you would want to really know. So you get to what is the remedy? We shall overcome Sharalin. We shall overcome Sharalin. But you need, now that you'll be doing this exam online, it's important you call CASNEB tomorrow. Tell CASNEB, hey, you guys, I'm your stakeholder and I'm not getting this particular what here, emails. So have you seen I've sent the document? Have you seen I've sent the document? Or you write to CP and Njuguna, FCP and Njuguna, FCP and Njuguna, FCP and Njuguna. Great. Have you gotten the document? 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 Abracadabra. Yes. So there are those students who normally don't get these documents. When I share them here, please download. Isn't that happen? Please download, and if possible, share it with us again on WhatsApp. Share it with us again on WhatsApp. Share it with us on WhatsApp. Yes. So tomorrow there is an online meeting. Unfortunately, I'll not be able to attend. Insist that, but I'll have my colleagues attending. I'll have my colleagues attending. Yep. I'll have my colleagues attending. It's important we get to see. The moment we see how the paper looks like, we shall be able to now come up with a clear strategy of ensuring that all these students in this case here pass. You know, you are the pioneers and I have the biggest number. I have the biggest number. Actually, it's like I'm training 90% of CASNEB students who are doing the data analytics out of 100, yes. So now we really have to work very hard. We have to work very hard, including the theory papers. So great. So have we gotten that already? Have we gotten this already? Have we gotten this already? Okay. So perhaps Margaret, out of these things that Procter and Gamble they are putting here, which one are you distributing to them? Which item are you distributing to them? Margaret, are you able to identify which, for example, beauty product are you distributing to these guys? They have skin and personal care. If you want the best moisturizers, they have hair care, grooming, great, baby, feminine, and family care. Great. Superiority, aha, standard of excellence. I love this. I love this, guys. Ladies and gentlemen, I would want to introduce something here to you, which is very important. The Excel, I deleted it. Let me get it, fetch it very fast here. Oh, great. Excel. Okay. You're overcoming, you're overcoming, you're overcoming. Now, one of those companies whose owner is on the roof, talking big, he has acquired Twitter. Do you know which company I'm talking about? Do you know which company I'm talking about? The company, biggest company whose owner has acquired Twitter. Have you ever heard of Tesla? Let me just show you. Tesla. Yeah. So I've been able to put these here, and I expect you guys to really go through these at your own time. Try to understand how they make money. What is their business model? What is their business model? Very important. Yeah. Great. Very important. But the most important thing for you for your exam is this P&L and the balance sheet. When you look at the P&L here, look at I've given you P&L for the last, how many years? 1, 2, 3, 4, 5, right? And then I have very important KPIs, which I would want you guys to calculate, like revenue percentage for automotive year on year, revenue percentage, etc. So we have gross profit percentage, gross profit. So I would really want you to calculate this for me. I'll not rub this. I would want you to see the formulas. I'll not rub this. I'll not rub them at all. I would want you to see the formulas. But I would want you to have a different like sheet where you calculate all these percentages. That's very important for me. Net loss percentage, overall gross profit margin, etc. The same case with under the balance sheet input, you'll be able to see very good ratios here that I've been able to compile for you guys. These ones here. This time I don't have a quick ratio. I have a current ratio, a DSO, a DIO, DPO, net trading cycle. Once you finish that, then you'll be good to go. You'll be good to go. You'll be good to go. I can see 2 charts here. I don't know whether it was about we shall overcome Asezi. Asezi wants to know so many things, which are even beyond your exam, which I would want to cover with you, but after you finish. So I would want to share this with you as well, so that you guys can get to do your homework. Is there somebody who has finished doing the first question? All of them? Anybody who has finished doing the first question? All of them? So I'll label this Tesla financial statements. Great. Not yet, okay? Tesla financial statements 1. File is in use. So must come here. Close it first. So have you been able to see the Tesla one? Have you been able to see the Tesla financial statements? Tesla financial statements. And then now you should be able to take a step further and look for like 2 Kenyan companies, EABL, especially if you normally take beer. Get those ratios for EABL. Get another company like Kenya Airways, which is doing very poorly. Get their ratios. Have you been able to download the financial statements of Tesla? They're not talking to me. I don't know why. They haven't seen it. Please download it because I would want to end the class. Downloading, okay, it's downloading now. Download, Helen, yes. So imepata. So you guys have enough work to do. See you tomorrow, the same time. I hope you'll have finished that, and then I'll be able to show you now something very important. I know you have done it with my colleague, but I would want to repeat the concept of how you link the income statement using these financial statements, linking the income statement to the balance sheet and to the cash flow, so that when you change one item here, everything changes. That's very important. That's very important. So kama mmepata, endelea mazoezi, tunaona kesho, same time. Bye-bye. Jabir is saying, wait. You can get from other students on WhatsApp.